ETF Prime is hosted by investment advisors of the ETF Store. This program is for informational purposes only and does not constitute investment advice. Investing in ETFs involves risk, including potential loss of principal. Any past performance figures discussed are not necessarily indicative of future results. The ETF Store is not affiliated with etf.com or any of its affiliates. etf.com's participation in this program should not be construed as an endorsement or an indication by etf.com of the value of any ETF Store product or service. Visit etfstore.com for more information.
Now it's time for ETF Prime, where we discuss everything you need to know about exchange-traded funds and the world of investing. Whether you're an investing expert or just starting out, Nate will help you get up to date with what's happening on Wall Street and show you how exchange-traded funds can help lower your investment costs, reduce your tax bill, and allow you to take advantage of investment opportunities around the world. And now, the host of ETF Prime, Nate Geraci.
All right, fun show this week. Joining me will be etf.com's Drew Voros. We're going to look at several recent ETF stories, including Fidelity filing for a Bitcoin ETF last week. You know I got to talk about that. I want to get Drew's take on AdvisorShares filing for a Gerber Kawasaki ETF. So this will be managed by Ross Gerber, who you may know. He has a real knack for finding an audience on social media. And if you think about it, this follows some other high-profile influencers getting involved with ETFs. So we'll talk about that angle. We'll also discuss this highly anticipated ARK Space ETF that's launching today. And we'll cover the ongoing ETF fee war. There were more fee cuts from both iShares and State Street last week. So again, this should be a fun conversation. I'll then be joined by John Keller, ETF product manager at Market Access, who offers a leading electronic bond trading platform. And this will be interesting. He's going to explain how they're helping bring the bond market out of the dark ages. And in my opinion, ETFs are a huge part of this story. I don't think there's any question ETFs have helped push automation in this space. And I should note that John was previously global head of fixed income ETFs portfolio management at State Street. You're talking about a true bond ETF expert here. So he'll offer a behind-the-scenes look at the ways Market Access is streamlining bond trading and the overall role of bond ETFs. I'll then close this week with Matt Tuttle, CEO and CIO of Tuttle Tactical Management. He's going to spotlight the first actively managed SPAC ETF, the SPAC and New Issue ETF, ticker SPCX. And not only that, Tuttle Tactical has filed for 2 additional SPAC ETFs, along with a fear of missing out ETF, a FOMO ETF, and a fat tail ETF. So I'll see what he's able to talk about on those filings as well. As always, questions or comments, you can find me on Twitter at Nate Geraci, or you can go to etfprime.com. Let's start with etf.com's Drew Voros.
Time now for our weekly chat with the experts at etf.com, the world's leading independent authority on ETFs.
I think we're seeing a different way of ETFs being launched.
The real kicker was governance, selling of private data. They really let down their customers repeatedly.
All right, Drew, this is going to be fun. We're just going to go around the horn on several ETF stories from the past week. And I know this is going to be a huge shocker to you. I want to start with the Bitcoin ETF filing from Fidelity. It's called the Wise Origin Bitcoin ETF. Now, this comes on the heels of First Trust partnering with Skybridge's Anthony Scaramucci on a Bitcoin ETF. Wisdom Tree has filed for a Bitcoin ETF, which, by the way, along with Van Eck, those applications are now in the formal review process with the SEC. There are also filings from Valkyrie, NYDIG. What do you make of Fidelity getting involved here? Any significance?
Well, clearly the Bitcoin barbarians are at the SEC gate, right, knocking and ready to climb over. There is a definite sentiment out there that we're going to see it now, perhaps sooner and later. In fact, I'm feeling like I need to move my goalpost back. I was thinking Q1 2022. Does feel like by the end of the year we will see movement on that, and perhaps by the end of summer. The reason I say that is because we are hearing even words coming out of the SEC that there are commissioners who realize that they're late to the ball game in approving a Bitcoin ETF. As now we have 2 in Canada that have just launched, nearly $1 billion in those in the last month. We have all these sort of backdoor funds that get you into Bitcoin and crypto, but to go around the exchanges of NASDAQ, NYSE, and SIBO. So I think there's a realization of the unintended consequences of being late to approving a Bitcoin ETF is proving not to be the best case scenario for investors, instead of having an SEC-approved gateway into what is clearly now both a speculative investment and a cryptocurrency, but it's clearly here to stay, in my opinion.
Do you think Fidelity in particular being involved here does anything in terms of accelerating the SEC's timeline, just given the size of Fidelity and sort of their stature in the market?
I think it's like a scrum, right? It's 4th and 1 at the goal, and you need that extra push. Clearly, Fidelity brings some lobbying weight. We saw it when Massachusetts was the first state to go after Robinhood for the gamification, they called it, of trading. And that clearly was a push. At least a lot of people reading the tea leaves saw that as Fidelity feeling threatened by the Robinhood market share that they're obviously taking. So again, I think it just adds weight. VanEck certainly is there. You've got Bitwise, you've got Wisdom Tree. You certainly have people coming into the game now. But the door is being knocked on by 7 people right now. And then we also have a whole hopper full of filings from previous that have never been rejected but haven't been updated or addressed, and those could happen just as quickly. We could be up to 15, 20 filings before we actually see an approval.
I guess on that note, you may have seen this. I tweeted this out last week, but I'd love to get your take as well. You and I have both covered this story for a long time now. And as I thought about this with somebody like Fidelity getting involved, I feel kind of bad for some of the smaller issuers who have put a ton of work into getting a Bitcoin ETF approved. Like for me, someone such as Bitwise comes to mind, where they've done tons of research on the Bitcoin market. They've literally sent hundreds, if not thousands of pages of documents to the SEC trying to get a Bitcoin ETF pushed through. And now it looks like someone, I don't know, like Fidelity waltzes in, maybe BlackRock does too at some point. And I think there's a decent chance that these larger firms end up reaping the real rewards, all because the SEC has waited so long. Go ahead.
I'll throw a wild card at you, Coinbase. So Coinbase is about to go public, IPO coming out. They've obviously been navigating the regulatory waters. Why wouldn't they offer an ETF? So they have a potential of losing market share to people that realizing the 1.5% in and 1.5% out to buy Bitcoin through Coinbase is higher than what an ETF is. They could easily package an ETF, Bitcoin with the Coinbase name on it, and keep their customers there. So I think we have not seen this dynamic play out. I don't think first come, first served works. And I don't think being, the biggest lobbyist group in the bunch works. I think it's just going to be played out. And as we saw, I think I mentioned this before, when the blockchain ETFs came out 3 years ago in 2018, they all launched literally on the same week during Inside ETFs, if you recall. So they were all approved at the same time. They literally stumbled over coming out of the gate like a horse race. And I think we could have multiple Bitcoin ETFs all launch in the same week, if not the same day. Because everyone is ready to go. Everybody knows what to do. It's just a matter of somebody shooting the starter's gun. Yeah,
I guess my question, Drew, is that fair to these smaller issuers? You think about the Winklevoss twins back in 2013 trying to push for a Bitcoin ETF.
I don't know what the regulatory standard is. I don't know what the fairness is. Is being first but sloppy? Is that supposed to put you in front of the line? Is it be late but you have more lobbying power? Does that put you in front of the line? I don't know what fair is in a regulatory mind that would make that decision.
Yeah, and I should mention VanEck has clearly done a tremendous amount of work here too. I think they're very deserving of a Bitcoin ETF, and they are a larger issuer. They're a top 10 issuer. It's just, again, it seems like the groundwork was really laid by the Winklevoss twins, and I know Bitwise came in strong. So if I were in their position, this would just be a tough pill to swallow.
But Nate, how many times have we seen on Wall Street a great idea is there, but the timing wasn't.
100%.
Right?
Yeah, we see it time and again.
And the highway is littered with ideas that the great idea was there, and that just the timing wasn't. And frankly, the industry has the Bitcoin industry has matured. And so the pricing mechanisms and the back door or the back shop mechanisms have matured to a fact that the regulatories are comfortable with it, I think. And we're seeing more futures products come out. We're seeing global pricing coming out, which has always been a very difficult thing. In fact, we're working on pricing we're going to have on etf.com for crypto. And finding that centralization is not easy because you don't have a central exchange like you do with stocks. So all of that is being worked out. And it's just, I think we're really, we know it's coming. We just don't know what month it is. And certainly looks like more and more 2021.
By the way, I don't take a lot of victory laps, but I'll take a small one here. I actually said last year, as it relates to Fidelity's filing, I thought Fidelity was a potential dark horse in the Bitcoin ETF race just because they were so early to crypto compared to other fund companies. When you think about how they built an entire crypto business unit with Fidelity digital assets. So this made a ton of sense to me.
And they've been in the custody. They have done custody.
That's right.
And you're right. But again, I don't know if the ecosystem works. I mean, maybe it's just judged on the filing. I don't think the whole mechanism necessarily is the case. We'll see, though. It'll be very interesting. Again, we could have 3 or 4 approved at the same time. Who was first doesn't really matter. But I don't think we're just going to have one come out and then everyone else has to wait another 9 months.
All right, let's move on to a few other topics here. Another filing last week that I want to ask you about, this Advisor Shares Gerber Kawasaki ETF. This would be managed by Ross Gerber. Gerber Kawasaki is his investment advisory firm. And for people who don't know, Ross is, I guess you could say he's a polarizing figure on social media. He catches a lot of flack for whatever reason. I think some people just think he's a marketer or a carnival barker. But you look, he has a large following, 140,000 followers on Twitter. He gets a ton of engagement. And so to me, people can throw stones at him, but he's doing something right. You may not like it, but it's working. The question I have for you, Drew, is this comes right after Dave Portnoy got involved with the index underlying the Buzz ETF. You and I talked about that a couple of weeks ago, as I'm sure you recall. Joe Pompliano, so one of the Pompliano brothers, he recently put his name behind the Roundhill MVP ETF. So to me, it looks like there's this trend developing with so-called influencers getting involved with ETFs. Do you have any thoughts on that?
Well, I think it's speaking to a retail audience that ETF issuers have overlooked and underserved. Because of compliance reasons or the profit margin doesn't work to go after a retail audience, I think there are issuers that see the opportunity here. With Portnoy, he has followers and he has people think gambling is investing, and that's what he has a whole entourage, millions of people in Barstool Sports following there. You just mentioned Gerber Kawasaki. And we're going to, what is the difference between that and a Quincy Jones ETF? I don't really know regulatory or compliance-wise, but what I see here is that they're using people to help sell ideas. And the idea is personalized in a way that resonates with a younger audience, with the TikTok audience, with the YouTube audience, and that's where the future is. And if ETF issuers want to maintain that they're only going to go after advisors and they don't want non-accredited investors, well, other people will take that money. And the do-it-yourself retail investor is growing. It's huge, partly because a lot of people have their money in a 401k, but they have play money. They have money that they want to, put in a Robinhood account and see what they can do. Free trading has done a lot. You can get in and out of a fund and only lose your money and not be racking up trading costs. So in that way, whether you call it gamification or not, the access is so easy that there are people going to be looking to play in the market. And ETFs are a way that are resonating with certainly a younger crowd, and a crowd that I think that is overdue to really go after. And again, if everybody wants to stick with the institutional and 401k crowd and the ETF issuer world, there will be issuers that will go after that market and they'll do well. We saw it, as you mentioned, Bets with Roundhill came out that was geared toward people that understood that Sports betting is going to be a thing in this country, just like marijuana ETFs are going to be a thing in this country. Whether or not you believe that that's right or wrong, there is segments of our consumer marketplace that are using these, and there's ETFs that are now covering these marketplaces, and how to sell that to the public is selling it sometimes to the people that are using those products.
No, I think that's well said. And I'll just add that I think we both know in the ETF space how important marketing and distribution is. And I think you could almost look at some of these relationships, Dave Portnoy, Ross Gerber. It's an extension of that distribution channel in the sense that they have such large followings on social media. And I think there's a lot of crossover between the people following them on social media and the people who are using Robinhood or SoFi or some of these other ways to get access to the markets. And so this is sort of a quasi-distribution channel. To me, it makes a lot of sense, and I think we'll see more influencers get involved here. Go ahead.
Okay, I was just say finally on that. Wait till Bitcoin ETF comes out.
100%.
How are they going to differentiate each other? And when there's 7 Bitcoin ETFs out there,
it's going to be marketing.
Coinbase, it's going to be marketing.
That's why I think you look at
stale marketing.
We'll look at First Trust with Anthony Scaramucci, right? I mean, there's a reason for that. Whether you like Scaramucci or not, he brings some branding, and he's going to target a certain segment of the market, and that could differentiate First Trust to a certain degree. Okay,
Drew, sell it on Twitter.
Just a couple of minutes left here. I want to make sure we get to the big news of today, which is the ARK Space Exploration ETF, ticker ARKX. This just launched this morning. I said back in February, I think this could be the most anticipated ETF launch of the year, unless, of course, we get a Bitcoin ETF. What are your expectations just in terms of the investor reception here?
Well, it's coming out the gate very strong. I think the volume's almost 5 million in the last 20 half hour or so as it launched today. I think the reception is that this is, again, we just talked about sort of the new game in town. This is the new game in town. What is Cathie Wood's new movie? I keep using the analogy. This is like her. This is the new Quentin Tarantino movie that's come out from the hottest director in Hollywood. So everybody wants to go see what she's come up with, and it's a theme that resonates with people. It's space. It's about drones. It's about the economy above our head, literally. And so it's coming out the gate. I think we're going to see a couple $100 million right off the bat in AUM. How long it goes, but she's also sitting in a very volatile market right now, where her kind of group of stocks, disruptive stocks, not mature stocks, very new stocks, the new generation technology, are taking a lot of hit in the market because of the market dynamics now with the yield spiking. So anyway, I think it's fun to watch, and I think it certainly shakes up the space. And again, it brings in a whole new kind of crowd to ETFs. This ETF will be talked about in mainstream media. So again, this is a ETF that is going to bring new investors to the ETF industry, or ones that typically may not have. Yeah.
Okay. Hey, Drew, something I was thinking about here. There are people who they throw Cathie Wood into this category of a marketer who's just looking to take advantage, right? You think about all the flows into ARK ETFs over the past year or so. I've actually seen people call her a grifter. But I thought about this. ARK has had hardly any new launches, right? They had that fintech ETF back in 2019, but otherwise nothing. Point being, that's not somebody to me who's grifting for dollars. I just wanted to point that out because I haven't seen people talk about that. They act like she's trying to, somehow take advantage. They've had one launch, prior to this, since they first debuted their lineup.
Yeah, I don't understand that at all. I mean, if anything, she stood behind her product. Here we have an active manager that's literally talking about the trades, and it's a wide open book. In terms of shaking up the industry, we were all anticipating, active ETFs coming into the marketplace with the secret sauce that, would, just literally jump over the fence from mutual funds. But instead, the hottest active product we have in the ETF industry is unlike what the old school did. This is wide open. It's investing in new and somewhat unproven companies, and she's clearly opened her book to everyone to see what she's doing. There's no mystery here. We can look at her top 10 holdings on this new fund, which also includes an ETF, 3D printing, by the way, which I thought was interesting. So the book is open, and it's going to be exciting to see another fund get into the mainstream and talk about both ETF investing and a whole new area in terms of technology and equity investing.
Drew, a minute left. I want to get your hot take on this never-ending ETF fee war. So last Monday, iShares reshuffled their lineup of Morningstar equity style box ETFs that included slashing fees. And this was across 9 ETFs with about $8 billion in assets and pretty sizable fee reduction. So they went from 25, 30 basis points on these down to between 3 and 6 basis points. And then the following day, State Street chopped fees on 2 of their bond ETFs. They had a mortgage bond ETF and a high yield bond ETF. And they did undercut both iShares and Vanguard in those categories. I'll just flip this on its head a little bit. So I looked at ETF launches year to date, and believe it or not, the average fee for new ETFs this year is over 70 basis points. Mm-hmm. So the question I have for you is, what's going on here? Like, is this the same old fee war and plain vanilla, and then issuers looking to make money elsewhere, or how do you read that?
I think the fee war has really been minimized with no commission trading. So I think in the minds of institutionals and advisors, it's still huge. That's why the Morningstar and some of the funds we saw were clearly advisor products and very basic portfolio bricks that are going to be much cheaper now. But in terms, you didn't read a lot of headlines. You didn't see any stories in Barron's and Wall Street Journal about the fee war going on again. And there were some big price cuts there. So I think it really depends on the crowd you're speaking to and how important fee wars are. But generally speaking, we've seen it go down to zero. We've seen trading go down to zero. And we're seeing actually people going into these funds now that aren't SEC approved for Bitcoin. They're charging Bitwise has a crypto index fund, has $1 billion in it, and they're getting 250 basis points as an expense ratio. People are walking into that because they want the exposure. They don't care about the fee. Same with Coinbase, getting 1.5% in and out with people buying Bitcoin. So I think the idea of fees really depends on who you're speaking with, but I think it's been minimized a lot just from the fact there's free trading.
Well, Drew, fun chat as always. Appreciate you taking the time. Thank you for joining me this week.
Thank you, Nate. Always a pleasure.
That was ETF.com's Drew Voros. My next guest is John Keller, ETF product manager at Market Access, who offers a leading electronic bond trading platform. And John himself has deep expertise in the bond ETF space. Prior to joining Market Access, he was global head of fixed income ETFs portfolio management at State Street. And he's now joining me via phone from just outside New York. John, welcome to the podcast.
Thanks, Nate. Thanks for having me.
Okay, so I think the portrait that many still have of the bond market is that it's really antiquated, right? That if you want to buy or sell bonds, you pick up the phone, you call around to multiple brokers, you look for the best price, maybe you do a little negotiating, and then you verbally execute the trade. I've said before, compared to the equity market, the bond market is still in the dark ages, just in terms of technology and infrastructure and how investors transact. However, Market Access is changing that. And so let's start by talking about how, and then I definitely want to get into some ETF-specific topics. So give us an introduction to Market Access and how you are streamlining bond trading.
Okay, that's great. You're right. The bond market is behind the equity market. We at Market Access hope that we're helping it catch up. Market Access, as Nate said, we're an electronic bond trading platform. We've been around since 2000, so we've been seeking to electronify bond trading since 2000. Historically, we've been a corporate bond trading platform. That was our first product. Now we trade emerging market bonds, municipal bonds, treasuries, so broadening out significantly. I would say that prior to the 2008 crisis, you're very right, Nate, that bond trading was still very much, even for the larger institutions, was an exercise of calling people on the phone or maybe using kind of a Bloomberg chat. After the crisis, we started to see more electronification. Market access volumes really started to increase at that point. Right now, if we look at fourth quarter of last year, about 23% of the investment-grade corporate bond market per TRACE, so TRACE is the reporting engine for FINRA, about 23% of the daily IG trades took place on market access. About 17% of high yield. EM is probably around 15%. So we've seen a lot of institutional investment managers and investors migrate their trading from the phone to platforms, obviously because of efficiencies. And we're at the point now where, ballpark 25% or so of reported investment-grade corporate bond trades are happening electronically on our platform.
And can you talk about some of the specific features of the platform? I know there's what's called the Open Trading Protocol. Just talk some of the blocking and tackling. What does somebody do when they access the platform? Who exactly is on the platform?
Sure. So, kind of back to your original point, Nate. The market started off as a request for quote. So think of your typical buy-side institutional investor. They need to buy or sell bonds. They would request quotes from their dealers. Typically, they did it over the phone. We've moved that onto an electronic platform. So now clients can go onto the platform, request quotes from 2 dealers up to hundreds of dealers, and receive those quotes back, and then select the best dealer or the best quote to trade with. Open trading, as you mentioned, Nate, is our name for our all-to-all protocol. So started off as a client-to-dealer marketplace, electronic marketplace. About 8 years ago, we launched Open Trading, where now market access as a broker stands in the middle, but it enables other clients to trade with, to provide liquidity on the platform. So no longer is a client that is looking to trade bonds just going to their dealers. Other clients or dealers that they're not affiliated with can now provide liquidity, can now bid or offer on those bonds. So it's really opening up the bond market to a much more exchange-like environment, because you no longer just have clients and dealers. Dealers can take liquidity, if you will. They can initiate. Clients can provide liquidity. They can respond, all with market access standing in the middle as a broker.
And in terms of how the platform is involved in the ETF market, as I understand it, investors can negotiate directly with ETF sponsors like BlackRock and State Street over, which bonds might fit in a high-yield bond ETF or something along those lines. Obviously, the platform can help facilitate portfolio trading, where larger bond traders can quickly buy and sell baskets using ETF creation redemption. It can help facilitate the arbitrage process for ETF trading. So if ETFs are trading at a premium or discount, can you just talk a little more about those areas that are involved in the ETF side?
Yeah, it's a great question, and it's really a progression, because if you think about it, the ETF market makers, the APs, are the ones that are interacting with the ETF issuers. So they're the ones that actually have the permission to create and redeem. So they need to trade bonds. And so historically, they were on our platform. So the Jane Streets, the Flow Traders, the Virtus, Susquehannas were on our platform as liquidity takers when they needed to buy or sell bonds. With Open Trading, they became liquidity providers. They were able to respond to inquiries and essentially cross the bid offer. They were now buying bonds closer to the bid side, selling them closer to the offer, because they were responding to liquidity. The next step is some of those ETF market makers have actually become dealers and started facing clients directly. No longer trading through market access as a broker, they're trading on our platform, but they're facing clients directly. And you're right, a lot of that, Nate, came about because of portfolio trading, which is really just all or none list trading. But if you are a Jane Street or a Flow Traders or a Susquehanna, and if you want to see those all or none list trades from a client, you have to face them directly. So they've migrated to now becoming dealers in some cases. So it's really been a progression for the ETF market makers. and because of our market share, our market presence, we've got the deepest pool of liquidity, and that cohort of the market, the ETF market makers, are always looking for the deepest pool of liquidity to execute their trades.
Going back to the bond market overall, I'm curious, what are some of the unique challenges in automating a market where the fact is some bonds hardly ever trade, right? And so I'm curious, how are bond prices established? How are global bonds handled, things like emerging market bonds? Give us a window into that back end.
Sure. So you're right. There are tens of thousands of CUSIPs in the corporate bond market, municipal bond market, easily tens of thousands of CUSIPs. Emerging markets, a lot of these bonds don't trade, but a lot of them are in indices that ETFs look to mimic, and they need to be priced every day such that the funds, the ETFs or mutual funds, can value their portfolios. So obviously, putting these types of trades on electronic platforms allows for greater dissemination of information, greater dissemination of data. We at Market Access, because of where we sit, we have a very unique view of the markets that transact on our platform. So we get to see both the buys and the sells. We get to see the depth of stack. So if you think about a client that puts a bond out for bid, there might be 10 responses on that bond, and then it trades, and the market sees the trace trade. They see the print of where it traded. We see all 10 responses. There are a lot of DNTs, so did not trades. We see all of those. So really, we're becoming our trading platform over the last few years has really started to manifest itself or allow us to offer a lot more data products in terms of where we think bonds will trade. Pre-trade visibility is huge for clients. If you're trying to figure out which bonds out of a portfolio to sell or buy, you need some estimation of where that's going to occur. So really being able to handle big data, harvest big data, and turn that large amount of data into products is one of our key focus areas.
Given that data that you have, are there any specific differences you would highlight between, say, government bonds and muni bonds or corporates, high yields, and perhaps how that then feeds into the ETF structure?
They all have pricing challenges. We saw that even last March with Treasury bonds, where the off-the-run Treasuries really struggled to trade, find liquidity, and find executable levels. Overall, from an ETF perspective, it really comes down to how broad an index is and how accessible the bonds are. So a Treasury index, so let's take like a TIPS index, there are 30 to 40 bonds in there. So it's easy enough for the ETF market makers and the authorized participants to trade all of the bonds in effective creation or redemption trade. If we look at a corporate bond or an emerging market bond or a municipal bond, there may be thousands of bonds in those indices. And so really you can't take delivery of or deliver all of the bonds in the index or in the ETF. So that really calls for custom basketing, which is somewhat more art than science at times, but that's where the negotiation process comes in between the ETF issuer and the AP or market maker in terms of which bonds can I deliver? Which bonds would you take for delivery? And that inefficiency in the bond ETF market is being worked out with greater data and technology capabilities, but it's still a real challenge.
Yeah, and you started heading down this path. I think anytime this particular topic comes up, there is always this discussion around a mismatch in liquidity, that ETFs trade intraday on exchanges. Well, some of the underlying bonds may not trade for days. And of course, if we go back, actually just about a year ago, we had a significant disruption in the credit markets where a number of bond ETFs did trade at sizable discounts. I would just love to hear your perspective on that in terms of how you thought bond ETFs function. Are there improvements that you think should be made? How did you view that entire episode?
Over the March, April timeframe, we think that bond ETFs held up really pretty well. Yes, they did trade at significant discounts to their net asset values. That said, the net asset values, if we're talking about ETFs or indices that contain thousands of bonds that oftentimes didn't trade, chances are, and I think if we go back and look at the data, it was the net asset value marks, the bond marks that were lagging. The trades that occurred in the ETF market, one, they were large dollar amounts, and they were executed by two willing parties, a buyer and a seller. We think that that's where risk was actually trading. It's obviously where risk was actually trading, and is a better barometer for where the markets were, as opposed to end of day marks on securities that in a lot of cases did not trade. One of the things that we're doing at Market Access is we are using our data, and we've rolled out an index business, came out in 2020, where we're building indices made of smaller, more liquid constituents, where most of the bonds are going to trade even on more volatile days. And if they don't trade, bonds that are fairly similar to them will trade. And so it's a lot easier for us to estimate where those bonds would have traded. And so we're working with ETF issuers right now in building some indices where we can roll out ETFs. We think that with the advent of portfolio trading, you'll be able to trade the entire index, the entire portfolio. We've talked with a number of dealers that'll be comfortable in making markets on the whole index. So we think that, it's still unproven. These ETFs haven't been in the marketplace and obviously haven't weathered a downturn. But we think that these types of indices and ETFs should have tighter premiums and discounts during volatile times, and should be more liquid in all scenarios. And so we'll see if that's the case. I think we'll be out in the marketplace later on this year with some ETF issuers.
John, just a couple minutes left. I started our conversation talking about how the bond market, really was in the dark ages. Clearly, it's making a lot of progress. But I'm curious, how important do you think ETFs have been in bringing automation to the bond market? Because from my perspective, I feel like they've almost forced the bond market into using technology and automation, just because, again, bond ETFs do trade intraday on exchanges. And so the back end of the bond market has had to catch up with the front end of the ETF wrapper. Do you agree with that? Any other color you would offer?
No, that's exactly right, Nate. And a lot of it's been driven by the ETF market, but really by the ETF market makers. So the ETF market makers are the ones that are continuously throughout the day having to price risk in the share market, the ETF share prices, and at the same time have an understanding of live risk in terms of where they can buy or sell the baskets to exchange for those shares in the creation and redemption market. And so they've had to create their own algorithms to price bonds based on market prints and based on data in the marketplace, even for bonds that don't trade. And then as they started to build up their algorithms and start to be able to bid and offer bonds more electronically or quicker, then the dealers needed to catch up. And then the buy side has stepped up. And so I think the ETF market has absolutely driven advancements in bond trading for the overall bond market.
Well, John, really interesting insight into the bond market. Enjoyed this conversation. Thank you for joining me this week.
Thanks, Nate. I appreciate the time.
That was John Keller, ETF Product Manager at Market Access. I'm now joined by Matt Tuttle, CEO and CIO of Tuttle Tactical Management, who's behind the first actively managed SPAC ETF. It's also the largest SPAC ETF. It's called the SPAC and New Issue ETF, ticker symbol SPCX. And Tuttle Tactical has two other SPAC ETFs in registration with the SEC, along with a Fear of Missing Out ETF, a FOMO ETF, and a Fat Tail ETF. And Matt is now on the line with me from Greenwich, Connecticut. Matt, great to finally connect.
Yeah, same here. Thanks for having me.
All right, so I have a bunch of questions for you, but let's start with SPCX. Again, this is the first actively managed SPAC ETF. Take us through your investment process, and then we'll circle back to SPACs themselves.
Yeah, sure. So basically what we're looking to do is to buy only pre-merger SPACs, so blank check companies. We're not buying DraftKings and Nikola or anything like that. We're looking to either buy them on the IPO at 10, buy them in the secondary market, either around 10 or these days under 10. We are looking for strong management teams. We're looking for management teams that have a track record. And now, since the SPACs have been out in this shape or form for a while, you're getting a lot of secondary, third-time, fourth-time issuers, so you can actually see what they've done before. We're looking to create as diversified a portfolio as we can from the standpoint of, these guys might be going for fintech, these guys might be going for clean energy, so on and so forth. And then we're looking to sell either, on some sort of pop or a rumor of a deal or an actual deal. So we're not going to hold the SPAC after it's merged into another company and becomes something that isn't a SPAC. So that's the process in a nutshell. Buy something around 10, sell it for higher than 10, and rinse and repeat.
Okay, so several items I want to unpack there. Let's start. Why only include pre-DAC or pre-SPAC? I'm sorry, pre-deal SPACs.
Pre-merger.
Yeah, pre-merger.
Right.
Yeah.
Because a pre-merger SPAC gives you an asymmetrical return stream unlike anything else you get on Wall Street. So typically if Wall Street comes to you and says, hey, I got this product that's got an asymmetrical return stream, it means your losses are potentially unlimited and your gains are limited. The cool thing about a SPAC is there's $10 in the bank. So if I buy a SPAC at 10, I know that I'm getting my $10 back if I want it. So my losses are limited. My upside is virtually unlimited. The SPAC sponsor makes an awesome deal. Wall Street loves it. It could go to 15, 20, 25. We've seen 60. So, that's what I love about pre-merger SPACs. It also gives individual investors access to something they've never had access to before. If you as an individual investor wanted to say, hey, Chamath, I want to invest alongside you, and, if you can put together a deal, I want to profit in it, there's no way to do that outside of a SPAC. Once it merges with an actual company, then it's an entirely different animal. Now you've got an operating business, you've got profits, losses, competition, marketplace. So it's an entirely different thing. I love that asymmetrical return stream.
Okay, so once a merger is announced, how long will you typically hold on to a SPAC, or how do you make that determination?
So we make that determination a number of different ways. First off, we're looking at, what does the price go to? Because we know we've got that $10 floor. So how far above that $10 are we? Because, the $10 is the net. If something goes up to 40, well, $10 doesn't help me much. So, that's kind of in nosebleed territory. So we're looking at that. We're also evaluating, how is Wall Street looking at this deal, along the lines of, what's the mood of the market right now versus where we think this deal could go. If we think there might be some more upside, then we might hold for a while. If, it pops to a level that we're happy with, then we may get out. And, and that could also be on a rumor. Churchill Capital was a great example. That popped to 33 on a rumor. And we're sitting there saying, all right, our $10 floor doesn't help us much when it's at 33. We've just doubled our money. Maybe a deal gets announced, maybe it doesn't, but this is a great exit point. We got out. It ended up announcing a deal, went up to 60, and then went down into the 20s. So we felt a little sick for a while when it was around 60, but now that it's in the 20s, totally happy.
In terms of your evaluation of pre-deal SPACs, you mentioned the importance of the sponsorship or the management team. And you mentioned Chamath Palihapitiya, of course, his SPACs have gotten a lot of run. There are now celebrities getting involved in the space, people like Shaquille O'Neal, Alex Rodriguez. Last week, I saw speculation that Donald Trump could have a SPAC.
I saw that, yep.
Yeah, so I'm just curious, I mean, what are your thoughts on the actual people involved here?
So the celebrities, to me, are eye candy. We're going to ignore them unless they bring something to the table beyond just, hey, look, we got this celebrity, look at me, look at me. If there's some sort of connections or something they bring to the table, we might not. But typically we're going to ignore that. And then we're going to look at the management team. And same process. Who's the management team? What's the track record? Ignore the pretty thing over here. Who are the guys actually behind it? Because my guess would be most of the time when we see these issued and there's a celebrity there, they're not the management team. They're some sort of strategic advisor. And you look through that and you look who the management team is. And so it really is the same process.
I had ETF.com's Sumeet Roy on the podcast last week, and we did sort of a deep dive into SPACs. And he had some data. I want to convey this to you. So already this year, there have been more SPACs offered and more money raised through SPACs than in all of 2020, which itself was a record year, which that blew away prior year records. What is driving this? Why are SPACs the in thing now?
So there's a couple of things, and it's coming from a lot of different angles. So we talked about for the individual investor. This gives the individual investor something they've never had before. It's almost like a venture capital, private equity type of thing that they've never been able to get access to before. And again, that $10 limit. And for, the Reddit guys and the guys who like the action, SPAC mergers are cool. So it's something that it's fun to talk about on Reddit and stock twits and all over and speculate on. From a sponsor standpoint, follow the money. The SPAC sponsors typically don't go hungry. They do very well. From an investment bank standpoint, I mean they're punching these things out. They're making money. Pipes, the pipe investments are short of maybe founder shares in SPAC deals, one of the best investments you can make because now you're buying a blank check company with complete and total transparency. So those are great. And then from, the IPO standpoint, there are a lot of advantages for a company that may have historically gone public through some other route to go public through a SPAC. So there are just so many advantages in so many places. It makes sense that it's exploded.
Do you think SPACs can keep up this pace of issuance? And I guess if not, will there be enough investable opportunities for your ETF down the road?
So no and yes. I don't think they can keep up this pace. I heard a quote that someone made. I think it might have been one of the co-founders of Zillow who said, at some point there'll be no private companies left. And, that's an exaggeration, but maybe not that much. So I don't think they can keep up this pace, but I do not think SPACs are going anywhere. And there will always, as long as they're not going anywhere, there's always going to be stuff for us to buy on the IPO, and there's always going to be stuff for us to buy in the secondary market. So that the market's always going to be there. So we actually welcome deal flow slowing down a little bit.
All right, before we move on, because I do want to ask you about these SEC filings, I just want to boil down the risk profile of this ETF. And as you mentioned earlier, basically there's a floor to the downside in that you have the underlying SPACs, right, with money sitting in a trust until there's a deal consummated. So how should investors think about the overall risk reward here, and where do you see an ETF like this fitting in a portfolio?
So I see this ETF fitting kind of where you'd put alternatives, depending on the portfolio, maybe 10 to 20%. The risk reward is going to change. So again, we've got that $10 floor, but if everything we own is trading at 16, then there is some downside there. But if you looked at our portfolio today, a lot of what we own is under 10. Most of what we own is right around that $10 level. So the risk reward of our portfolio today is a lot different than the risk reward of our portfolio a month ago when the SPAC market was very frothy. So the risk reward, I'd love to be able to say, yeah, it's this. It's going to change. When the SPAC market is frothy, then we're going to be holding a lot of SPACs that have appreciated. When the SPAC market is not frothy, like now, we're going to be holding a lot of SPACs around basically par value, and there's not a lot of risk at a point like now.
Okay, so this is perfect, actually, because your firm did recently file for 2 other SPAC ETFs, the D-SPAC ETF, and in the event there is a frothy SPAC market, a short D-SPAC ETF, D-SPAC meaning post-merger deals.
Correct.
Yeah, what can you tell us about these, if anything?
So, a couple of things. So there's been a lot of research saying, hey, when companies come public out of a SPAC merger, they're not a great investment. And people use that to pull out, so SPACs are bad. Well, no, we're selling before. So I don't really care if a company merges and then it goes from 10 to 5, I'm already out. But there's still, those stocks end up being basically momentum stocks, and people like to invest in them. So we wanted to create a fund where someone could say, okay, part of my portfolio I want in companies that come out of SPAC mergers, part I want pre-merger SPACs, versus there are a couple other SPAC funds out there that are mostly companies that came out of SPAC mergers. We wanted to say, hey, Mr. Investor, you decide. How much do you want of each? But we also understand, because these SPAC companies are momentum stocks, at some point they're going to get crushed. And, at multiple points. That's the way momentum stocks go. They run up and then they just get taken out and crushed every once in a while. And there's no good tool to be able to either hedge that or profit from that. So we had a lot of institutional clients who were buying SPCX saying, hey, if you guys could create this, we'd love it. But, okay, we'll do that. So we want to give people the tools both ways on the D-SPAC companies, because those are the ones that are really going to give you the wild ride both ways.
And did I see these are index-based?
These are index-based, yes.
And why is that versus the actively managed SPCX?
So active management to us is extremely important in pre-merger SPACs. It's not as important in D-SPAC companies, number one, because what we're doing is we're taking the 25 largest, and if we were actively managing it, we'd probably be doing the exact same thing. But to create the inverse side, it is a whole lot easier to do that based on an index than trying to actively manage the inverse side with the way that we've got to make that work.
All right, just about a minute left here. I have to ask you about these 2 other ETF filings your firm recently submitted to the SEC. There's a FOMO ETF, fear of missing out ETF, and then a fat tail ETF. What can you tell us about those?
Yeah, so what FOMO is about is taking everything that's going on. So right now that's SPACs. That's all the social media stuff. That's the innovative technologies. That's the fight between growth and value. Taking all of those things and combining it into a portfolio and investing in those things in, for lack of a better way to say it, a safer way. So what we're doing is we're combining everything. We're very active. We're rebalancing the portfolio weekly, which is obviously somewhat different. And we're risk weighting all of our holdings. So it's a way to say, hey, Mr. Individual Investor, you're seeing all this stuff going on. You want to participate in FOMO, but you also fear you've got that fear of getting killed. The second one is it's basically a positive carry tail risk fund. So it's really designed to replace what bonds used to maybe be able to do, which is something you can put into your portfolio. When the market's going up, it's not going to hurt you. And when the market goes down, and not goes down 2%, I mean goes down like 30%, it's designed to hopefully make 30% on the upside.
Well, I've got to tell you, I'm very interested to see both of those ETFs come to market, along with the SPAC ETFs. We'll definitely have to connect again once that happens. But congratulations on the success of SPCX thus far, and thank you for joining me this week.
All right, thanks for having me.
That was Matt Tuttle, CEO and CIO of Tuttle Tactical Management. That'll do it for this week's ETF Prime. As always, you can find me on Twitter @Nate Geraci, or you can send comments through etfprime.com. Next week, I'll be joined by Alpha Architects Wes Gray. We'll talk value rotation, momentum, ETF white labeling biz. And then Nancy Davis, founder and chief investment officer at Quadratic Capital Management, will spotlight a tremendous ETF success story, the Quadratic Interest Rate Volatility and Inflation Hedge ETF. Until then, have a great week, everyone.